To increase the sales of your products or services? Well, you're in the right place. United States Real Estate Investor is a platform you need to place your brand directly in front of your target audience. With our focused, growing audience of real estate investing beginners, enthusiasts, and seasoned professionals, you can continually reach our captivated viewers and listeners with ease. To learn more or to get started today, just visit UnitedStatesRealEstateInvestor.com/advertising. That's UnitedStatesRealEstateInvestor.com/advertising. Get ready to increase your brand awareness and your bottom line. Attract clients with content.
Hey, welcome to This Month in Real Estate Investing. In this episode, we'll be covering a variety of news items, including 2023 could be an explosive year for real estate investing. Here's why. How the AirBNB gold rush could impact the home buying market, and the biggest investment winners and losers from 2022. Also, stay tuned at the end of today's show for a special announcement. This Month in Real Estate Investing is sponsored by Jason Palliser's 2-day investment blueprint and REI Content Packs. Our guests today are Bronson Hill, Chris Prefontaine, and Jen Plessis. So let's bring our guests in, and why don't you guys introduce yourselves in that order and give us some background on who you are and what types of investing you guys focus on.
All right, so I can start here if you're ready. My name is Bronson Hill, and I work with Bronson Equity. We are a firm that basically helps people to generate passive income through real estate, mostly multifamily and other alternative assets. We have our ATM machine fund, and we're doing some other alternative stuff in the energy space. And got started about 15 years ago in real estate, did some medical device sales or consulting for years. And about 4 years ago, got into multifamily. We've got about 2,000 multifamily units, mostly in Jacksonville, Florida and Atlanta, Georgia. And just really excited about talking about, basically all things finance, but especially things passive investing and investing outside of Wall Street and into Main Street. So I'm excited to talk today. Some of the topics look really exciting. So I'm excited to be here. So thanks for having me, James.
Awesome. Chris, you want to jump in?
Yeah, Chris Prefontaine, founder and chairman over at Smart Real Estate Coach. Been at this game 31 years. Went through the lovely crash of '08, and that caused me to re-engineer my whole business. Mm-hmm. What that looks like today is we don't use banks. We do everything creatively. When I say we have a family company, and then we teach students all across North America to do the exact same thing, where we actually partner in deals. So excited to dive in wherever this might take us organically. It's going to be fun.
Great. Jen.
Great. Well, I'm happy to be here. Thank you so much. And to be in such great company. I have been in the financial services industry for 4 decades. I'm an avid real estate investor. I have a mortgage consulting firm and an investment firm. I do Airbnbs. So I'm excited to talk about this topic today. I do a lot of Airbnbs and I hold a lot of notes too. So that's what I'm doing. I do a lot of syndication, passive income now. But that's primarily what I do.
Fantastic. Well, I'm excited to have you guys on here. Let's just jump in the news. So the format of the show, I'll read off the headline, read a summary that I've put together, and then pose some questions to kick things off. So first one up from Reuters. Blackstone's $69 billion REIT curbs redemptions in blow to property empire. So Blackstone reported a 9.3% year-to-date return for its private equity REIT, in contrast to publicly traded Dow Jones U.S. Select REIT, which reported a 22.19% decline over the same period. A spokesman added that they relied on a long-term fixed rate debt structure, making it resilient. The problem is that the REIT is marketed to wealthy individual investors. Many of those investors are from Asia, and there's turmoil in Asian markets, which contributed to a high percentage of redemption requests because they need the liquidity. As a result, they only allowed investors to redeem 1.3 billion, equal to approximately 43% of investors' repurchase requests. So they run the risk of getting caught in a spiral of selling assets to meet those redemptions if it cannot regain the trust of its investors. They've agreed to sell interest in 2 Las Vegas casinos, equaling 1.27 billion, just to cover that initial round of redemption requests. So one question to kind of kick things off, are they inflating the stated returns to reduce panic? Or is the fact that they are using fixed rate debt versus adjustable rate financing a major differentiator that make them more stable and profitable than other publicly traded REITs? Anybody want to jump in?
I wish I knew the magic answer to this one, guys, because it's not my space. However, when it's not, if I'm tracking with you, James, if it's not publicly traded, that first one you went over, I think therein lies the challenge. It's not my specialty. It's not my space. But for all those things you just said, that's why it's not my space.
Yeah, same here.
I have some thoughts on this. So we do multifamily apartment investing. We're typically buying older stuff built in the 70s, and we're renovating them. So REITs are a real challenge for a couple of reasons. Just kind of give people a background. People think, oh, if I invest in REITs, is that like getting into a private deal with other multifamily or other stuff? And there's a couple of challenges with it. One is that kind of this issue is that how do you value what's in the portfolio, because it's not publicly traded. So they kind of can set the values kind of how they want. I don't know exactly how that works, but there's a certain period of time they can say, oh, this is valued this way. And actually it's very common that for REITs, the actual value of the assets, if you sold the assets in the REIT, you'd have about a 5 to 10 I think it's about 5 times. I don't know the exact multiple, but it's a multiple that goes on top of it just to be able to have liquidity. So for example, let's say you have $1 billion in here, it will trade for like $5 billion on the public markets, but you only have $1 billion worth of real estate, right? So you actually have this inflated value because it's liquid, right? And that's a disadvantage of multifamily syndication, like what we do, is it is illiquid, but you pay a lot more to have that liquidity. So one of the challenges with REITs is, and kind of what we're seeing here is that when you have things softening in the rental market or in the commercial or whatever is in the REIT, as those prices soften on these newer assets, there's no real value that they're adding, right? They're just simply buying and holding it. So you own the real estate market. So if the real estate market goes down, you don't have any margin of safety, as Warren Buffett talks about, right? So versus value add, anything you can add value to, whether it's a flip or it's an Airbnb or like what we do with large multifamily apartments, we buy stuff and we renovate and we know, okay, we're going to increase rents by this amount by putting in $5,000 per unit. Well, with REITs, they can't do that. First of all, because they're too big. And secondly, because they're buying brand new properties, right? So there's a couple issues there, but I think kind of going back to the primary thing is the valuation is very difficult and they can kind of say what they want. And then they can just, it's kind of odd, this is totally a Wall Street thing, right? They can just say like, oh, we're just going to stop redemptions. Like you just can't get your money back for as long as we say, and then we'll open it up when we feel like it. So a lot of challenges I find with REITs.
Interesting. Yeah, I was reading through that and doing some research on other articles, trying to get my head around it because it's a whole other animal. Jen, do you have any experience in that or have any comments?
Well, the only thing I want to say about that, no, it's not my area of expertise at all, but I know finance very well. And I know that this is a runoff. No one wants to hold low interest money right now. So the fact that they're redeeming is probably a good thing. They just want to get it off their books. And so they're valuating it higher because there's some merit in being able to liquidate at a lower interest rate for the future. And so they probably want to get it off their books. So I see it as a runoff. I think it's arbitrary and I think it's inflated.
Gotcha. Well, why don't we jump into the next one, since we don't have a lot more to add to that. This is from the Motley Fool. 2023 could be an explosive year for real estate investing. Here's why. Quick summary. So 2022 wasn't a fantastic year for investors, with the median home price reaching its highest point in history, then came down quickly as home buying slowed due to high inflation, high interest rate environment. The high prices, high cost of borrowing, high competition, and tremendous economic volatility meant a lot of real estate investors have stayed on the sidelines recently and are waiting for better buying opportunities. So I got a lot of questions for you guys. Do you think prices will climb, flatten, or drop? Let me just read off all my questions and we can just kind of spitball. What markets will be better to be in? How will interest rates, inflation, inventory, and pent-up primary home buyer demand affect us as investors? What about falling rental demand? And what are your views on focusing on cash flow and risk mitigation? And I can read those off again if you want me to cue those up again. So
Yeah, I'm taking feverish notes.
Here, I'll put them in the chat.
I know.
How's that?
Yeah, that would be good. Then we can address each one of them. Well, I'll tell you what. I'll go first for this one. This is right up my alley. I talk about this all the time. And so I'm looking over here at the, will they climb, will they flatten or drop? I think the answer is yes, because it depends on the market. We're seeing values continue to increase in very hot markets, lower sales prices, and we're seeing a decline in values in higher price markets. So, and that has to do with interest rates because the affordability index is now dropped. So we're seeing that, so I think the answer is yes, it's going to happen in different markets. Do we want to just address all that first, or do you want me to address everything first? What do you want to do?
Keep going if you want.
Okay. Yeah, I'll keep going.
Yeah.
So what markets will be better to be in? I'm always challenged by this question because I think the market you should be in is the one that you know. So I think it's going to just depend on who's left the market and, sort of put their hands up and said, I'm done, done with the competition. I'm done fighting against first-time home buyers and properties. I don't think we have a supply issue anymore as much as we had before for materials for any rehabs. So that's getting better. We're seeing that builders are now increasing the amount of building that they're doing. They're doing them faster. And one of the markets that's really climbing right now for the investor side is ground up, right? We're seeing a lot of lots being purchased, multiple acres being purchased and divided off and doing ground up rentals. So the market is definitely needing that and wanting that. So I don't see a softening in the rental market, particularly when we have pent up demand everywhere. We have a demographic that's coming into the United States. And of course, in the Southeast, let me call it the South Central, right? That's definitely going to be a hot market just because of what's happening, with the borders. But we're not seeing so much, of a softening in the rental market that I've seen. And actually year over year, it's higher. So there might be some areas that are dropping a little bit. So that's why investors are saying, look, well, I'll go out and I'll buy some property and I'll build it because I can get access to it, access to the financing for it. I can get access to the materials for it. I have a hot client, that's coming in, and the demographic is right there for it. So that's what we're seeing, as far as that goes. But again, I think it's whatever market you think you want to be in. We're kind of backing off of Airbnb, and we'll talk about this later, but we're backing off a little bit about in Airbnb and really focusing on notes, land contracts. We're just holding a lot of notes on a lot of properties. If we can buy them free and clear, we'll just flip it into, a land contract. How will interest rates, inflation, and pent-up demand? Yeah. So the Mortgage Bankers Association predicts that interest rates are going to be dropping down to 5.4% at the end of 2023. So we're going to have, we've gone up, the Fed's just raised rates, but the good thing is they only raised them by 0.5%. They didn't raise it by 3/4, which means that they feel like they're kind of teetering and getting closer to, at the supply and demand, in competition with inflation. So what we're hearing from the chairman of the Federal Reserve is that there will continue to be rate increases, but they will be smaller increases. So we may see an eighth or a quarter, and see many of them through 2023, but that is intentional to drive down inflation so that the interest rates can drive down as well. So from 24 to 25, I think it's going to be killer. We have aging millennials who are the largest demographic that we've ever seen, bigger than the baby boomers. And they are now, moving out from that first home, right? Moving out into that. And I think we're going to see a lot of buyer demand in that area. And so as an investor, I'm prepping to get ahead of the buyer demand because the buyer doesn't see that. But as investors, we're seeing that that's happening. I really don't want to talk about falling rental because I personally don't see it. And the statistics aren't showing it yet. What are your views on focusing on cash flow and risk mitigation? Yeah, I mean, as a lender, right? Because I still lend money. I do financing for investors as a lender. DSCRs are now, at 1.25%, 1.5%. We have to see that. There's maybe one or two investors who are doing 1%. But we definitely want to see cash flow. Cash is king. That's the word that's being used everywhere. Cash is king. Liquidity is king. No lender wants to hold a property ever. So at least in the financing piece of it, we want it to be successful. And if that means saying no today to save our industry, we'll do that. And then the last piece about this is forbearance. So I know a lot about what's going on with forbearance, and watch out. We're going to have a slew of foreclosures because people think they have enough equity that, hey, if I can't pay my forbearance balance, I'll sell my house really quickly, but it'll be a fire sale because there aren't enough buyers out there with the rates being high. So I think that's going to be a fantastic market for investors.
Great.
James, there's a whole bunch that, Jen, I love everything you said. So rather than kind of go bullet, I literally, even though I'm from New England, don't disagree with anything you said. I like the high points, but I do have just comments, and then we'll see where it goes. And I'll glance at the questions at the same time. One is, my niche is a little different. I'm in creative real estate, so I love the direction of everything right now. And I'll just some statistics because I know Jen's shot some out too. You've got the third time in 50 years, third time only, we've had an affordability challenge here. And this started like in the summertime when rates weren't even what they are now, which just screams loudly to the need for a guide in the creative world, investors that want to do creative real estate. And then what did that do in different pockets? Because we're represented all over North America with our students. We get like a microcosm of society. We get to see that. The sellers are coming out of the woodwork now because the craze is not here anymore. So I think from a creative real estate standpoint, in my 31 years, it hasn't been this good. And I don't see it changing for the foreseeable future. I love how Jen answered the interest rate thing because we don't know. The billionaires don't know. And if anyone tells you they know, I would be careful. No one knows that answer. What I do know is this, and I think I want to hear everybody's opinion on this. There's one constant here on the panel, and that is that we're on real estate. And if we're on real estate, the constant is it's going to keep changing. When I restructured or re-engineered the business after the 08 crash, it was specifically to be able to pivot in all markets, not to say, I got to change this direction. I got to change this direction. It was to be able to keep operating in every market and just changing maybe the pockets that I'm operating in, again, inside the creative world. So if we know there's an affordability problem already, there's hundreds of thousands of buyers that literally get kicked to the street. A year ago, I have grandkids and young kids. A year ago, they thought they could buy a home at X, and the interest rate changed that whole picture. So if we can be a guide to them, the demand is enormous. And then the interest rate issue now for us, buying properties on subject to existing financing, we're grabbing properties, to Jen's point, with people that need financial relief. We're grabbing those at 2.9, 3.5, last week, 2.75% underlying interest rates. That's a huge, huge opportunity for the next couple of years. So just some of my general thoughts on the market, why I'm actually excited about what's going on right now.
I love that we're all kind of approaching it from a little bit of a different, kind of approach to, we have different businesses that we do, but we're obviously all in real estate. And that's what I love about real estate, is that people say, how is the real estate? How is real estate? And I'm like, well, what do you mean? Do you mean single family, multifamily? Do you mean commercial? Do you mean in the city, out of the city, Sunbelt states, California, where, all this stuff? There's a lot of different ways to approach it. But we talked to a lot of investors. I've had 1,300 one-on-one phone calls with investors over the years. And really, from an investment standpoint, really, I think the important thing to look at is, what is, compared to what? Meaning, like, if I have cash sitting in the bank, if I've got $100,000 in the bank, what are the alternatives that are out there? And a lot of investors we've seen lately have kind of the last 3 to 6 months have just slammed the brakes. But there's, when I talk a lot about inflation, there's a real risk of inflation. Now, officially it's 7.1% or 7.2% at the time of this recording. There's a site called Shadow Stats that actually measures actual inflation. It actually says it's around 15% annually. So if you just wait, over the next 1 to 2 years, you could be losing 30 to 40% of the purchasing power of your dollars just by waiting. So I'm seeing a lot of people, especially a lot of retail investors, just waiting. So maybe, hey, I know I should do something, but I'm waiting. I personally think that right now it's actually a really great time to be invested. Because when you buy a property, whether it's a single family or it's a multifamily property, your buying price is fixed, right? You just, if we pay 10 million for an apartment, that's fixed. That won't change. The interest rate potentially can be adjusted later. And really the interest rate, I think, is really the elephant in the room, right? It's the thing that's causing pricing to come down a little bit. Affordability is down, particularly with single family homes. If I pay a 3% interest rate versus a 7% interest rate for a single family house, my total escrow payment is 41% higher, at least. Right. So this is huge change just as far as having to pay more money. But if interest rates do come down in the future, it'll allow me to refinance. A lot of people feel like, and even the Fed is broadcasting, they're going to raise rates kind of consistently this next year, and they're going to keep them high. I personally think in the next 3 to 6 months, this is not a popular opinion, but I think in the next 3 to 6 months, I think the Fed is actually going to start reducing rates due to an inflation. Historically, over the last 100 years, my friend Jeff Clark put out this chart, and it showed that from the time of the first rate hike, which was in March of 2022, historically over the last 100 years, they've always cut rates. It's between 1 and 13 months later. The longest it's ever been is 13 months, which would put us into April. Now, they could go longer, they could go a little bit longer, but my thought is in the next 3 to 6 months, they'd like to keep rates high, but there's already this conversation about things potentially pivoting. So I don't want to talk too long, but I do think that investor sentiment is important to look at. I think that, things, depending on where you are, I love buying in areas where there is growth. In Jacksonville, Florida, we're still seeing lots of people move there. We're seeing lots of people that are retired and want to live in Florida. It's a little bit cheaper to live, and we're still seeing rents continuing to stabilize or to even grow a little bit. So I think it depends on the market. I think if you're buying in a market like Cleveland or an area that is not experiencing population growth, it's more flat or declining, it's just going to look a little different. We might see some more price declines in these areas. But again, it's very, very much depends on which asset we're looking at, what market, what timeline, a lot of that stuff. But I think it's a great time to be invested as a real estate investor.
Fantastic.
Yeah.
Well, that was a good one.
Yep. And can I say something to all that too? I just want to bring it back. Sorry about that. I just want to say something. That one of the things that we have to look at, and I think that a lot, I'm speaking to both of you actually, but I can't see your names anymore. Oh my gosh. I'm learning everybody's names, but, if you do a side-by-side comparison of the flurry that was happening in 2020 and barely into 2021, right, and barely into 2022, the value of homes was increasing. Obviously, we had appreciation, but then we had escalation clauses on all of the properties, right? And so home buyers, and I'm just talking about the home buyer side on this, not the investor, but it does have relevance. And so the home buyer side of this was, well, I'm willing to pay another $50,000, $80,000, $100,000 in an escalation clause because interest rates are 3% or 2 3/4. And so they were willing to pay these escalation clauses, no home inspections, no financing contingencies. We saw lots of people lose their earnest money because of that, and no seller concessions. So when you compare that to what we're looking at in today's market, values have we'll say flattened. They've gone up, but they've gone up, and not as quickly. So values have flattened. We're not having escalation clauses in many markets. We're not having escalation clauses. We've got a more balanced market where sellers are now starting to sell, and they're giving up their 2% and 3% rates, right? So we have a more balanced market. So they're willing to give sales concessions. And so you get the home inspection now, and you get the financing, it's all coming back in. So when you actually do a side-by-side comparison to then versus now, the payment differential is nominal. And if we can educate our home buyers in this, because we will continue to have appreciation, then it's crazy not to buy a house. You just refinance it later on, and it's crazy as an investor, not to do the same things. So I think, when we think about fight, flight, fawn, and I call it, well, everybody does flight, fight, fear. I put fawn in there as well. I feel like a lot of investors are fawning. They're just caving and they're sitting back. But when we look at, this is something I've been talking about quite a bit, is now's the time to focus and accelerate instead of hibernate. This is the time to really find out what all the creative options are out there and position yourself, to be in a position to be able to strike when the iron's, really, really hot. And we have a recession most likely coming ahead of us, at some point here in the future. And one of the things we know historically over, since the 1950s when rates have been tracked is that rates go down during recessions. So the fact that we thought we had a recession, but no, it's not really a recession, that's a good sign for us. And rates did go down. They were creeping up to 7.5% and 8%. And they did come back down during that blip of a recession that was 1 month that someone said, oh, it's not really a recession, but they came down. And that's, I think, what we're going to be seeing here coming up. So anyway, I just wanted to throw that in too.
Thank you.
James, I want to say something about Jen said, because it's huge. That relative to timing, this is specifically when fortunes are created, specifically in the next 24 months. I'm screaming as loud as I can to our community that you double down in the next 24 months, you create a decade or more of income. And that's a fact if you know how to pivot and operate in the creative space. So the media screaming the opposite. Great. That should be a big sign to go get in it and get in it hard.
Exactly. Yeah. And like Jen, you said, having tools, having all the different strategies is good. All right, let's jump into the next one. That last one was fantastic. From Newsbreak, why real estate investing in San Diego will boom in 2023. So values in San Diego have trended downward over the past few months, but interest rates are continuing to rise, making mortgages much more expensive, and fewer buyers are interested in purchasing homes. Additionally, fewer home buyers can sell and then buy a new house due to high interest rates. But they say that there will still be opportunities for adding value with fixer-uppers, adding ADUs, and millennials will be motivated to get creative with house hacking by renting out extra rooms, since they'll be able to and willing to have roommates. So a couple of questions for everybody. Are you familiar with that market? And do you see other opportunities that may have been missed in the article? Put those questions in the chat there.
I have students there, James. I'll keep mine brief. We have students there, but again, we're such a niche and a niche and a niche in what we do in the creative world that a lot of what you said doesn't touch us, frankly. So I'm not, from a 10,000 foot view, I'm not going to be an expert on that. I can just say that we can, no matter what market you bring up to me, I'm going to probably answer the same way. If you know how to buy in the creative world, then you can pivot and do quite well. So I'm not going to address San Diego in particular on my end.
I'm just going to say one thing. I'm actually going to San Diego later today for a little planning kind of year-end strategy session, goals for the year. So I live in LA, and San Diego's 2 hours away, and so I'm familiar with the market. But it's funny, we have our 200 million in multifamily assets. We don't own anything in California. Even the house I live in, I don't own, just because California markets are very challenging. I think that, but to this article, it's always a wonder, like, who's writing the article or what's the motivation to write it. Sometimes, I think a lot of these things like house hacking and renting rooms and fixer uppers, this stuff's been going on a long time. So I didn't really see anything in the article to me that was like, oh, here's a really compelling underlying reason. It didn't really address interest rates. It didn't really address demand or growth in that particular market. So I didn't really see a lot to me that made it say, oh, this is something that sounds reliable. Just sounds like, hey, I see some other opportunities here, which is good. But again, it's not really my expertise, more in single family, but it's something I do follow.
Yeah, it's interesting that everyone has just a little bit to say about this. I feel the same way. I'm very familiar with San Diego. I'm there quite frequently, and I'm familiar with the market. But I felt like the article didn't warrant a lot of support for anything they were saying. It was very opinionated, and it started off with, the fact that interest rates continue to climb, and they aren't climbing, right, and that people are backing off, and I think that just again through education, people are now starting to come out of that woodwork. We are finding a balance. It was all buyer, and then everybody was sitting, and now we're finding this balance where sellers are willing to give up their 3% interest rate, to go find something, and they have confidence that they're going to find something. So I didn't put a lot of warrant. In fact, when I read the article, I was like, well, maybe I won't even comment. Right? So, yeah.
Right on. Well, let's take a break and learn from one of our sponsors. Are you ready to ignite your financial freedom with what has been called the hottest REI strategy around? Or should I say strategies? Enter Jason Palliser's 2-day investment blueprint, where you'll learn the secrets that real estate investing community doesn't know because they never had a reason to before. With Jason Palliser's 2-day investment blueprint, you'll learn how to tackle real estate deals with over 40 different strategies, which means your chances of losing another deal nearly disappears completely. In Jason's 2-day life transformation intensive, you will learn how to get more deals, close deals faster, win more deals over other investors, multiply your real estate deal strategies, and much more. Jason Palliser's 2-day investment blueprint can help you grow your REI business to 6 and 7 figures faster with much less aggravation. If you want to learn how to actually invest well in any market in the US, even the tough markets, and close multiple deals per month, visit 2dayblueprint.com. That's the number 2dayblueprint.com. And make sure you tell them you heard it here on This Month in Real Estate Investing. Don't believe the no more good deals hype, and visit 2dayblueprint.com today. All right, let's get back to the news. CNBC's Make It says 23% of Americans think real estate is the best way to build wealth, but only 12% bought in 2022. So this is a little bit of a longer summary. There's a lot to kind of dive into though. So when asked the best way to build personal wealth, 23% of adults said investing in real estate ahead of investing in stocks at 16%, starting your own business at 15%, and getting a second job or side hustle at 12%. But 27% of respondents invested in the stock market, and only 12% invested in real estate. Their assumptions for the difference were that you need to either pay cash for the house or mortgage the property, not to mention fix up the property and yearly maintenance. Plus, the average cost of a 20% down payment has grown by 35% to nearly $63,000. So wealthier respondents were more able and likely to have invested in real estate. Only 6% of respondents earning $50,000 or less said they bought real estate this year, compared with 12% earning between $50,000 and $99,000, and 21% earning $100,000 and up. They go on to say it's not a better investment, even though investors were making a lot of money with home prices being up 10%, while stock prices declined more than 15% over the same period. They They point out that I'm almost done here. They point out that stocks have a long history of delivering compounding, wealth building returns that outpace the rate of inflation over time, and that real estate has a record that shows that long-term returns often match or barely exceed inflation. Since March 1992, home prices have logged average annual growth of 5.3%, while the S&P 500 posted an annualized total return of 9.5%. So the big question I assume we are all thinking about is, how are they comparing these returns from stocks versus real estate? And is it apples to apples? Ed, go. Go for it.
I know we're all chomping at the bit here. I think we got to consider the source, right? First of all, I don't know in the last time I had a bunch of real estate experts on CNBC, but that aside, a couple of comments I wrote down. I just wrote real estate in quotes. Like, they used real estate, sort of what was mentioned earlier. They used it like it was a generic term. Like, we just can't. There's so many niches and sub niches within real estate. So I love that whole thing. I think that's ass backwards. I also would be remiss not to say this, because I can't stand as long as you guys can. Stocks, I'm going to step on toes here, but stocks can go to zero. We all know that. They can. Real estate, I don't think my property is going to go to zero. I don't care what the market does. I don't care what I lived through in 08 in the crash. My stuff didn't go to zero. So I don't know. I think we got to put this in context. And then I wrote down a big capital letters, education. I think they're talking about buy and hold. I don't think they're talking about any of our niches, frankly. And education's a biggie. And the last thing I'll say is, relative to this article, and I'll dive in with you guys, is there's just a lot of mismanaged expectations out there. So education and expectation. There's a lot of confusion when people look and say, I know that I admittedly know that I can build wealth there, but I don't go do it. I don't go take action. Well, there's too many get rich quick ads. There's too much cloudy things out there. So education's a big deal, and you got to be with someone that's been at this through different market cycles, like all of us. Bronson, I think you were the one that said something earlier about the real estate. The word real estate is different. It's different. So anyway, that's real generic, but the article is obviously slightly slanted for CNBC.
Very true. Jen, did you have something to say?
Yeah, I mean, I have quite a bit to say about this. I mean, it's interesting. It's interesting. And like you said, slightly slanted. I don't think it's slightly slanted. They didn't ask the homeowners what they felt about the equity that they've gained over the last year and a half, right? Because everyone's talking about it, and they're taunting the fact that, I have so much equity in my house. But the bottom line is, equity means nothing unless you're at the point of sale. None of it means anything. Equity is just an arbitrary figure. But the reason people didn't buy is because rates went up. The competition was too stiff, and a lot of people pulled out of it. That's why they did. But it's interesting. And I have no idea why people did stocks. That is the craziest thing I've ever seen. That's the most volatile market you could ever, experience. But one of the comments in the article was, that 20% down has gone up 35%. The problem that we have, and Google, and actually there's a statistic out there that 67% of millennials say that they understand exactly what it takes to get a mortgage. But when asked what the down payment was from those 67%, only 13% of them knew exactly, or knew that it was, how do I say this? Only 13% of them thought that the down payment was less than 20%. That means that most people, 80% of these millennials that we talk to, think that the down payment requirement is 20%. It's not. It's 3%. It's 3% down to buy a home. And when you have a market increasing like this, why in the heck wouldn't you want to buy into this? Who cares? Refinance later. Here, let me ask you this. What's the rate on rent? What's the interest rate on paying rent? It's infinity. Infinity. There's not anything that goes to principal. Nothing. You get nothing. It's infinity. That's the interest rate on rent. And you're afraid of 6%. And historically, the average rate is 6.5% to 7% over the last 50 years. We're back to a normal market. And I think this is so slanted just to get everybody riled up. That's all.
Yeah.
The percent return, sorry, Bronson, the percent return thing kills me, only because Jen brought it to light with something she said. It triggered this. because in the creative world, not to water it down, but we don't put down payments down. And there's exceptions, but generally speaking, it's minimal.
Right.
And yet once they learn how to do that, my son-in-law went out and bought it, and my daughter went out and bought their first house creatively without going through a bank. Because that's, once you learn how to do it, you can do that. And so the percent return kills me. We create infinite return if you want to go that way. Because if you put a $10 deposit down on the property, which we create 75 grand, 100 grand, 250 grand on some deals, that's kind of a big return. So that's why I thought the percent return thing was comical. Sorry, Bronson.
Yeah, and of course it's not thinking about investors, right? It's all about owner occupied. This is leaning to owner occupied. You're not thinking about the cash flow you get as well, and the depreciation and the write-offs. And you just don't. Yeah, it's silly.
Yeah, all those start adding up when you start looking at that equity pay down and all that. All right, Bronson, go for it.
I read in college, and it was a statistics class, and it said how to lie with statistics. And really, that's what's being done on that what you mentioned this article. It's like, well, it's not an apples to apples. You're not looking at the value of homes versus the value of real estate. You're looking at the value of how much was actually put down. And you guys both brought that up, right? You could do owner finance, you could have 3%, 5%, even 20% down, and these returns go way, way up. And so I actually, part of my past, I'm not always proud of, I used to be an investment advisor for a few years. And I feel like it was like coming out of the dark side and coming back to the light. But, I've wondered, why do people think that stocks are traditional safe investments? I mean, stocks go down. I mean, I've done quite a bit of study about this. They've gone down 30 to 50% over a 12 to 24-month period, multiple times the last 100 years. I mean, how would you like that? I say, here's a great investment, but there's a chance it can go down 30 to 50%. I mean, they're just incredibly risky. Yet they're sold that these both stocks and bonds are safe traditional investments. And these days, if you look at the last 40 years since 1982, we've had a huge, real bull run in stocks, primarily because interest rates have gotten lower and it's pushed people into more risky assets, such as stocks. But if you go back to 1929, which there have been recent valuations in the stock market, if you look at the price earnings ratio, then very similar to 1929, there was a time where if you invested at the peak in 1929, things dropped and they didn't get back in nominal terms, meaning in the same dollar terms, for 25 years. So that would be like investing now and losing what you have. And a lot of these people are older, some people in their 60s, 70s, 80s in stocks, and you're losing money. You don't get back for 25 years. It didn't happen until 1954. And if you count inflation, it wasn't probably till another 10 or 15 years after that. And there was a season in there where just people said, why in the world would you invest in stocks? But things have changed so much the other way. But I think we might actually have some return to that type of, stocks are incredibly risky. But again, why do we feel this? It's because articles like this, there's just this common mantra, and Wall Street firms spend literally billions, tens of billions of dollars educating us that stocks and bonds are safe, that you got to have a 401k, all this stuff. So that's why owning real assets, like all of us do, and a lot of, obviously somebody's interested in watching this is interested in getting into real assets because it's a far superior asset. And even if everything else goes to zero, financial assets such as stocks go to zero, your house, your rentals, your apartments are worth something. And if inflation's there as a hedge, there's all kinds of embedded benefits that are there.
Dirt, right? Dirt's worth something. Yeah.
What was that, Chris?
Yeah, I have a general comment. Oh, you have to leave, Chris? Go ahead.
No, I got a few minutes left. I was just going to say, if you listen to the four of us, right, and you're an investor listening to this, I hope it screams loudly that please don't listen to the news and media. Like I wouldn't pick up that article ever. But do go look at people in the niches where you want to gain the experience and follow them. Please, like block out all the noise. That's all I wanted to say. You have four right here, and you have hundreds and thousands all over the country that know what they're doing with this stuff.
That's exactly why this show has value, because we pick some of these news articles like, that's pretty weighted one way, opinion wise. So it's good to dissect this and really dig into it.
Yeah. No, I totally agree. And I think, you can say that the stock market's gone up 27%, but then I dare you to open up your 401k, your quarterly 401k statement. My daughter just opened up hers from September, right? They lost $86,000 this year in 401k.
86,000?
And I said, you realize if you had that money flowing, you wouldn't have lost anything this year at all because everything was growing. Right. Yep. And she's like, yeah, I need to get with you. It's amazing. Yeah. So stocks are your 401ks. I just want people to understand that too.
Mm-hmm. in the chat, there's a comment about, we've got all these new apps where you can invest in stocks. That's probably having a little bit of an effect, especially with millennials that are used to that kind of thing. And
easier.
Just steering away from the complexity and high cost of getting into real estate typically, and just, I'll just throw some money at that. I've been looking at the ones where, we've talked about them on this show, where you can invest in real estate that way too. I'd definitely
NFTs.
go that direction, just knowing.
Mm-hmm.
There's tokenization too. So I emceed a conference called the Blockchain and Real Estate Summit in Austin, Texas, this in 2022, this fall. And basically there's a huge, they're trying to basically break up, and it was everything from multifamily deals to fix and flips. There's got a flipping fund or some sort of other, short-term rental fund. There's people doing all kinds of stuff and tokenizing, which it just basically allows you can invest as little as $100. You hold it for a year. Eventually there'll be a place you can sell these tokens. It will give more liquidity. But then I get concerned about the whole liquidity thing, that if you can sell super easily, then it brings in some of these financial Wall Street type of people that become traders of those assets and things like that. So, but it is something that I think, as stocks and bonds and Robinhood and all these apps for stocks are there, I think that there will become more options in real estate, especially for the tokenized properties.
Hey, Chris, I know you got to go. Maybe this is a good time to share with how people can get a hold of you.
Sure. And sorry about the scheduling. I'm going to blame my team and deal with that. Best way to get me is I just talked about education. Best way to get me is grab our books. Don't go buy them. I'm going to give them to you free just for listening to the show. Just go to Wicked Smart Books, wickedsmartbooks.com/James. You'll get those. It won't ask you for 10 cents for shipping. You'll get the hard copies because I'm big on free. You hear us talking here. I want you to say, well, this is a niche for me, or this is not. I'm going to go over here, but certainly do that for free. So that's the best way to do it. You'll find me on there too.
Fantastic. Cool. All right, let's jump into the next news from Nexstar Media Wire. How the Airbnb gold rush could impact the home buying market. Sure, we can dive into a lot here. So summary: Airbnb reported its highest revenue and profit ever in the third quarter of 2022, due in large part to strong demand and higher daily rates. And real estate investors have been amassing large portfolios of short-term rental properties to cash in on the boom. But many investors jumped in without the appropriate tools or skills, and many of them were funded with risky loans backed not by large down payments or borrower salaries, but by the potential future earnings of the rentals themselves. The problem is that the total short-term rental supply in the U.S. reached 1.38 million listings in September, up 23% compared with the same time last year, and 62% have been added since 2020. Also, occupancy has dropped 1.2% year over year, suggesting that supply is outpacing demand. In cities like Palm Springs, California, and Summit County here in Colorado have put caps on any new short-term rental permit applications. So do any of you have short-term rentals, and what are you doing, or would you do if you had them, to prepare for a shift?
So this isn't really my space necessarily. I do follow it, but I'd love to hear from Jen as well, because I know she's involved with this. But I think, there's a lot of different factors on it. Showed, you said 62% increase in the number of listings on Airbnb since 2020. I think there are some trends that are happening here. I think that because people can work remotely, because people were, unable to travel, Airbnbs have gotten really popular. I think even in 2020, because people wanted to stay in a house or an apartment or somewhere separate and not in like a hotel with a bunch of people. So there's people both for safety reasons or other things. And then I think people just, some people, if they work remote, I know actually some people that are kind of the digital nomad type, they just kind of go from place to place and find a place to stay and are doing it. I think that if we do, or if and when we do have a recession, I think this will be affected. And I think it's very market specific. So I think if you're around a big metro, it's interesting. I was actually looking for a while into buying a short-term or like an Airbnb. We have a mountainous area near LA called Big Bear. It's about an hour and a half, 2 hours from LA. And there's another area, Palm Springs, which has just been on fire. And Palm Springs was like a just constant, any time of the year, super busy, versus Big Bear was very seasonal, right? In the winter, there were a lot of people coming to ski or snowboard. In the summer, a lot of people there, but in the spring and the fall, it was much, much slower. So I think, they have a lot of data on this, kind of how things are going. But I think the question really is, what's the trend? Like, what's actually going to happen? And I think that, the more a 23% increase in 1 year, eventually more and more people start renting their houses out. I think in a lot of markets, it should hopefully give people a little bit better deal when they use Airbnb. I do know some people that have an Airbnb fund or run high-end Airbnbs in Scottsdale, Arizona, and they're seeing some rents or the prices for short-term rentals for the overnight stay daily rates going down a little bit. So I do think there is some impact. But I think it is very market specific, and I think it's going to be different in different markets. Some of that's also unknowable to know that which markets are people going to offer Airbnbs more, and then how's that going to change with demand. So I love to hear Jen's thoughts on that too.
Yeah. I'd add to.
Well, I mean, go ahead.
Oh, just a vacation rental place like Summit County. I know they're putting a cap on things because the workforce, that they aren't making hardly anything. So where are they going to live? And you got to feed the beast by having workforce, right? And if all these properties are being eaten up by Airbnbs, like where are they going to live to be able to serve those people that are coming in? So.
Yeah, and not having that affordable housing for them and everything. Yeah, and especially there. So where are you in Summit County?
I live in Castle Rock, south of Denver, but it's 70 mile drive up there.
Yeah, I'm from Colorado.
Oh.
I'm from Colorado originally. Yeah, we lived in Breck. I went to Colorado State.
Nice.
Yeah. Okay. So there's a lot of things that are going on with this, and especially in the financing pieces. But I do think there's two things that we need to be looking at. Pandemic, obviously everyone was trapped. And so that's where people started saying, well, let's go someplace and we'll stay in a home. And, with Airbnb, we Airbnb this home I'm sitting in right now. And, we, with Airbnb, there were, strict regulations and cleaning things that we had to do. And, and I thought for sure that would pull everybody back, but in fact it was good. And all of that, but the pandemic, obviously, and then as soon as the pandemic was, over, if we call it over yet, as soon as it was over, people started traveling, and that's really where the demand came in. And no one wanted to stay at a hotel with a bunch of other people. They wanted to stay, isolate a little bit. We personally have seen a drop of 38% in the nightly amount that we collect here. And we're right in the middle of Northern Virginia and beautiful hunt country, steeplechase country. I live in the wealthiest county in the United States of America, and we've seen a 38% drop in the nightly fee just to get people to come in. So there's definitely a trend. I do think it's happening. It's segmented by regions and areas as well. There are some areas that are more hot than others, and I do see that that's happening as well. But one of the things that I want to talk about is that a lion's share of, and I don't know the percentage right now or any statistics on this, but a lion's share of the Airbnbs that are rented are actually rentals. Those aren't investor owned. They're owned by individuals, and we have a plethora of Airbnb business people that go in and it's not a sublet. Okay. So make sure we know that, but they go in and they rent from the landlord, and then they, it's almost like a wrap, right? Like a wrap mortgage. They wrap the rent.
Master lease.
And they do it. Yeah. I'm sorry.
Like a master lease.
Well, it's not even that. You just do a regular lease. I've got one too. So you just do a regular lease, and then you don't have any other subleases because these people are, migrating in and out and in and out. So it's just the agreement that I'm going to manage the property and all of that. So it's interesting to see. And, as you were talking, I was thinking, what does this look like as we roll this ball down the road, that now I can't afford, nobody's coming to the house. I can't afford to pay the rent that I promised the landlord. The landlord's been relying on it. Are they going to be able to rent it out the way that, the traditional rents? Will it be a lower amount? How does that impact that? There is some type of trickle down that will happen in this market. So that's on the rental side. On the buying side, or the investor owned side, short-term rentals, that type of financing is halted right now. Absolutely halted. I just went to Private Lender Expo up in New York a couple of weeks ago, and everyone has halted short-term financing, the short-term rental financing. It's not happening at all. Do they agree that it'll come back? Absolutely, but it's starting to pull back. So I think it's had its heyday. I think this article was, the gold rush, I think, is over. I think now you're writing the article, right? And sometimes you don't know when you're at the lowest until you start going the other way, or the highest when you start going down. So I think that the gold rush for Airbnb has subsided. And I think that there's going to be a lot of shakeout based on, people, inflation. Will people still be able to travel? Will, what's going to happen? What's going to happen? Right now we have low unemployment, but as time goes on, we may have high unemployment. It'll shake that out a little bit more. So that's what I think is going to happen with that. So we're cautiously optimistic. We still have our house rented out. When I'm traveling, it rents out, and we're good. And we haven't had to make a mortgage payment in 5 years in this place. And, it's $1 million house. So we're happy. We're happy about it. Right. And I'm really haven't had to do anything with any of the properties. We've got 15 of them. I haven't had to do anything with most of those as far as making payments. They've all been taking care of themselves. So I think it's a really good investment, but I just be really careful about the way you enter this investment to ensure that you have the long-term gain on this and not just some short-term gain, because you'll have the long-term pain.
Yeah. You want to make sure it will rent traditionally long-term, not just short-term, right? In case maybe they start pulling permits. Like, oh, you can't do that anymore. That would be that'd be a bad situation.
Well, there are so many people. We went to a meeting here of Airbnb and bed and breakfast people here in our county several months ago. And what the county found out is that 85% of the people that are running these Airbnbs have not filed with the county as a business. And they're not licensed to do it. We happen to be licensed. Our company is called Betaway Escapes, right? And so I'm paying all the fees and all, the hospitality fees, and quarterly and all that good stuff to make this, the right way. But I think that we're going to find that there'll be a lot of fees that are going to be paid, some fines that people are, because the county said we're going after people. You can't just do it out of your house and pretend.
I thought, because I was a super host for a while, renting out a room in my house. And I in order to at least be booking through Airbnb, I thought you had to have your county permit, city permit, whatever, to even be on that platform. Not true. Huh. Interesting. No, well, and Denver County may be different.
No, you don't. Yeah. And look at your counties. Yeah. And that's the thing, is look at your counties. We have some, there's some really quirky stuff out there. We're on 21 acres. And so you can only rent out your house as an Airbnb if you have 20 acres or more. You have to own or occupy your house, right? So I could never decide, hey, this is really fun. Let me go live someplace else and I'll just keep renting this out. Can't do it on 20 acres or more. Can only do it on less than 20 acres. It can be an investment property. So yeah, there's a lot of little nuances that everyone needs to be aware of. But my biggest concern is what happens to the homeowner when those rents were paying their mortgage and they can't afford to pay their mortgage.
Yeah. And that's the biggest risk. I mean, there was a time you're talking about the gold rush in Airbnbs. And I had a friend, even in the multifamily space, that had an 8-unit apartment complex in Memphis. And he was able to buy this for $200K, or this was back, 6, 7, 8 years ago. And then he put about $250K into it. So he had about $500K in this 8-unit place. It used to be that he was getting $450 a month, $450 Midtown Memphis per unit. And then after going in and doing, he did basically a short-term rental apartment for all 8 units. And he was getting, and this was 4 or 5 years ago, he was getting about $2,500 a month immediately after he did that. So he was getting 5x the amount. Now, the challenge is the going in price now is very difficult to find those kind of deals. And so the margin, Warren Buffett, the margin of safety it's just not there. So if you're buying, you have to be very, very conservative on your numbers. And just like you were saying, Jen, if the cash flow isn't there, then you start saying like, does the investment still work? And that's really the issue, particularly in high end areas, because the buying price is so much higher.
Hey, Jen, I have a question.
Yeah, I agree.
You were talking about short-term rental loans. What's the difference between any other investor type loan, 20% or more down?
Because so some of them so we either fix and flip, right? Fix and sell. We fix and lease or rent, right? We turn into a long-term rental, or we fix and short-term rental. And so the distinction on that is the elevated DSCR, right? It's arbitrary, right? We're going, whoa, this is pretty good.
So it's
now
a
we know
DSC.
why.
You're talking a DSCR loan,
debt
service coverage ratio loan. Okay. Gotcha.
Yeah. So there's concern about that it, the historical rents that came from the appraisal are not what today's rents are. Right. And so it's a inflated number. Yeah. And so they're like, hold on until this sorts itself out. We're going to back off a little bit. Yeah.
Yeah. Yeah. I'd heard the DSCRs were on hold, or at least not being handed out as often. So interesting. All right. Well, let's move on to our next headline. Bazinga. Apartment developments spur self-storage boom. Bronson, this is your space. Yeah. More than 3.1 million new apartments were added nationally from 2012 to 2021, with an all-time high of 427,000 new rentals added to the U.S. market last year, and nearly 350 million square feet of storage space was added across the U.S. from 2012 to 2021, representing 22% of the total existing inventory. Data trackers use storage space per capita to determine if there's a shortage. This was interesting. I knew they were doing this, analyzing these markets. So I didn't know how. So markets like Houston have 10 square feet per capita, while New York and New Jersey are at 3.4 square feet per capita. So a few questions I've got. Let's start with, what opportunities do you guys see? I'll paste them in the chat here for you.
Sure. I can start talking about it too a little bit. So I think this is an interesting article. I'd never heard of Bazinga, so it's good to get familiar with Bazinga, but it seemed like a well-written article, and it's written by somebody who's not really, I always feel like a lot of articles are written kind of by a biased source. I'm just
going to say that this is not my area. Yeah.
Okay. So it seems like the article, it kind of touches on two things, right? It talks about multifamily growth, and it talks about self-storage. And I think both are very interesting. Talks about how many units came online. There's, all these many hundreds of thousands or millions. Well, there's articles the last several years that have come out and shown that we're just at a massive shortage of apartments. So what we really slowed down in 2008, 2009, and we never really caught up. So we're short. One article says, or one study says, we're short 3 million apartment units. Another one says we're short about 5 million. Another one says about 8 million apartment units. So we're short a lot. And so that, and it's really more acute in certain markets. So I think that there are markets like Jacksonville, Florida, that are occupied 96, 97%. There's just no housing units, and there's still people coming in. So where do these people live? So that's definitely an issue. I do like self-storage. I've invested in it as a passive investor. We haven't brought investors to self-storage, but I didn't realize this. There are actually more self-storage facilities than there are McDonald's, Starbucks, and Burger King combined in the U.S. So more self-storage facilities. So this is just facilities, maybe, somewhere between 50 and 200 units per facility. There's more of those than there are Starbucks, McDonald's, and Burger King combined. So there's a huge amount. It's just the numbers are staggering. We don't really notice this stuff until we actually need it, but it's basically all the D's, right? Death, divorce, displacement, people move to apartments, all kinds of things. So they kind of do go hand in hand, and there is a lot of growth. There's different ways of metrics of finding those. So I feel really good about both, self-storage as well as apartment investing. I think even sometimes I have a good friend who manages about $1 billion of investor capital to, have this huge portfolio for self-storage. But yeah, I think it's a great asset class. I think there is continual demand, and I think that it's, from businesses, it's from individuals, it's from people. They just intend to put it in there for a little bit, and then it just ends up staying in for years. So I think it is a great business also.
The ones you're investing in self-storage specifically, are those pre-owned that you're going in and just buying something existing, or are they new development?
Yeah, so this was actually a redevelopment in the Milwaukee, Wisconsin area. So it's taking a historic building where there's some tax credits involved, taking an old historic kind of warehouse building and turning it into self-storage. And honestly, the performance hasn't been awesome. It's been okay, but it hasn't been what I'd hoped. And I think that's more of an operational issue than it is the actual demographic of what's happening in the space. But I know people that have done very well. One of the challenges with self-storage, we've seen this in multifamily too, but it used to be mobile home parks and self-storage were trading at like 10 caps like 4 or 5 years ago. And now they're trading at like 4 or 5 caps. So they basically become what multifamily is. They used to be a huge premium to multifamily. Now it's kind of equal. So I've had people that have been lifelong or, years and years done self-storage and done mobile home parks, that they're now moving into multifamily because they're not seeing it doesn't have quite the benefits it used to have. And then there are other large players in there as well. But I do think it is a very interesting space, and it's very recession resistant. Actually, if you look at the last 15 years, self-storage has performed, almost all other real estate asset classes as a whole. If you're looking kind of broad as a whole, it's done phenomenally well.
Yeah. I know a lot of people trying to get in that space.
Yeah.
So as a apartment syndicator, and you're doing new development as well as buying existing, or
we don't do any new development personally. I personally think right now, and just in general, the new development stuff is pretty risky, just because you buy it, you commit to do it, you put the capital out, and you don't know, in 2 years, the market could look phenomenal. It could look terrible. And it's that time risk, right? And also, even if you're not developing, if you're buying brand new, built within the last 10-year apartment buildings, there's no value to add. So if I live in Pasadena, California, rents are $4,200 for a 2-bedroom. If they go down to $3,500, which they would in a recession, or they go to $3,000, that could really hurt the property, or they could even lose the property, unless, depending on the financing. So I see it as being a much more risky proposition, that, hey, we're going and buying this place, as long as we can renovate 80% of these units, knowing we can take the rents from $1,000 to $1,500, which is currently where the market is. There's 2 types of appreciation. You have market appreciation, where it just goes where the market is. And then you have forced appreciation, which is more like a flip, right? That, hey, if I do this, I can increase the value by this amount. And that's kind of really what we look to do.
Yeah. Gotcha. Yeah. With like new construction apartments, I was thinking, why aren't they adding self-storage into their plan? Like, put it on the same plot of land, or if they don't have enough, just build something elsewhere. And they're capturing
I was
going to
say, I think mobile home parks do that a lot. Quite a few of them. We're in a mobile home park syndication, and there's a storage unit on the mobile home. So rather than, and actually it was pretty funny, because the way that it was developed when it was purchased was that there were some of the single family and double wide slabs, right? And they just, part of the syndication, erected storage units right on those slabs. They were already there. They were sitting vacant. So instead of having them be vacant, let's see if we can't get some of the stuff that everyone's accumulating into, those storage units, and get a little bit more money, on a monthly basis. So that's the extent of what I've been involved with it. I have a colleague who just sent information to me about a storage unit syndication, and I don't know. I haven't really looked at it. I have a different focus right now, so it's not something I've really looked at.
Yeah, it is definitely a thought. And I know there's a lot of smaller properties that have 10 storage units and 10 apartments or something, but it gets to be very difficult to try to manage these. I actually have a friend who's got a place in Texas, some rural town in Texas, that has a car wash, that's like a do-it-yourself car wash or self-service car wash, and it's some self-storage. And it's just hard to find really good managers for that, right? So if you do it, and not everybody, let's say you have a 200-unit apartment complex, not everybody's going to want storage. So maybe 10% of those people are going to want storage, but how do you manage the 20 unit versus if you do it separately and, across the street or a mile away, There's a storage place where they have 200 units, where they've got good security, and there's all kinds of things that have to go into that to try to manage those efficiently. So it's very difficult to do on a small scale. That's why a lot of storage units, I think, that are done well, they're typically 100 to 300 units, or sometimes even more, just because there's some security issues, there's some management stuff. You don't want to have too many people there. It doesn't make sense to have one staff when you've got 20 units, and then if people are breaking in, how would you know? And so there's some issues that kind of go with that. So it's interesting.
Yeah.
All right. Hey, let's hear from our next sponsor. One of the best ways to increase your company's brand awareness and increase warm leads is to create written content online. But as we know, content creation can sometimes be a slog. Content creation can be very time consuming and not very cost effective when having to pay professional copywriting fees. It's time to stop spending countless hours writing and paying exorbitant copywriting fees. It's time to use REI Content Packs. REI Content Packs, done for you. Content Packs give you the tools, flexibility, and cost-effective way to increase your brand's visibility and online presence without spending hours or even days stressing out on what to create. REI Content Packs are a collection of high-quality, ready-made real estate blog articles exclusively created for the real estate investing industry. Can you imagine the possibilities if you could do 2 to 3 more deals per month without increasing your ad spend? REI Content Packs can help you do that. Can you imagine getting unlimited online traffic, increasing your Google ranking, getting more leads, and making more money? REI Content Packs can help you do that too. To get started increasing your brand's awareness and lessening your workload, head on over to thismonthinrealestate.com/REI Content Packs and tell them you heard it on This Month in Real Estate Investing. It's time to get off the online marketing hamster wheel. Try REI Content Packs today at thismonthinrealestate.com/REI Content Packs. Okay. Back to the show. So on Fox Business, headline is Governor Ron DeSantis takes steps to help the average person afford a home. With new home building permits down last month to their lowest levels since 2020, Don Peebles, a developer, warned of a double whammy coming to the market that will price average Americans out of an affordable home, and applauded a Florida initiative attempting to fix the problem. He explained that a double whammy due to the declining demand because buyers can no longer afford to buy what they could have bought last year due to higher interest rates and inflation, or they're completely priced out of the market. And then on the development side, the credit markets are essentially freezing. And I assume he means that will cause development and inventory to stay low, which will keep home prices too high for many buyers. It then goes on to say that Governor DeSantis' bill is seeking a $1 billion reinsurance fund, reduced litigation costs, and to force some customers to leave a state-created insurer that has been in trouble since 1992 when Hurricane Andrew flattened Homestead, wiped out some insurance carrier companies altogether, and left many remaining companies fearful to write or renew policies in the state. Risk for carriers have been growing as climate change increases the strength of hurricanes and rainstorms. So the move by DeSantis hopefully will make it more appealing for people wanting to move to Florida and keep their economy moving along. So there is a lot to unpack there. Do you think this is just a Band-Aid or a real solution? Let's start there, and I'll post my other questions.
So we buy quite a bit in Florida. So we buy a bit in Jacksonville, and we're seeing insurance costs after the hurricanes go up. And it gives an example in this article is for single family that some guy's paying $1,700 a month for his 3-bedroom annual insurance, and it's gone to $7,000 or $8,000, and he's able to finally find somebody who's able to give him for $5,000. But to have costs go up by several times, 3 to 4 or 5 times, it's a real challenge. But there are real losses being taken by these insurance companies. So I don't know. I don't know if the state, how do they get involved to help? I think addressing it is important. It sounds like there's some really frivolous litigation that's taken place where the attorneys really get a lot of money, and that really hurts insurance companies. And then it turns out what premiums are actually being paid. So if there's a way they can stop some of that, it can potentially help. But it's a big issue. I mean, and the challenge is, people love Florida. Like, I'd love to live in Florida. It's great, but they have hurricanes, and it's been the last couple of years have been pretty rough. But I think what will happen, from a free market standpoint, is that maybe, costs will go up, and then eventually over time, a couple of years, they start to come down again and whatever. And so I don't know. I think it's a good idea to try to address it, but I don't know if there's really an easy answer for it. And I don't understand, I'm not a huge insurance guy to understand all the different elements of what reinsurance actually means. And does that mean the state's actually going to fund that, or is a private company going to force private companies to fund that? But I think that the fact they're addressing it and trying to find a solution, I think is good.
Yeah. I was not sure what reassurance was.
Yeah. I think reinsurance is really the
insurance.
It's basically when like they share risk around. So it's like if let's say there is a damage there's groups that reinsure to make sure, that if, this insurance company doesn't have a liquidity, they'll basically, like sell out some of this policy or the amount that they have coverage needs for, and this larger group will help to kind of reinsure. So you can have a very small insurance company, but because they now have coverage and they have different agreements to help, and everybody, they get paid to say, okay, we'll cover $1 billion worth of, reinsurance in case there's an issue. That's how I understand it. I could be, maybe not have the full understanding, but I think that's how it works.
Yeah. When you guys are buying,
that's how I understand it. Oh, go ahead and ask a question. Sam.
So Bronson, like you guys are buying in Florida, assume you're looking at the trend and building that into your numbers, right? But where are you seeing things going?
Yeah. Well, I mean, it's an issue because we're having issues with getting insurance for properties. We're having, even properties that, like our properties in Jacksonville, really weren't affected by either the recent 2 hurricanes at all. I think there was some debris that showed up on the beach, but I don't think power went out in Jacksonville. But because it's in Florida, there are groups that are just saying we don't want to do this in Florida, which is we're only an hour and a half or an hour from the Georgia border. So if you're in Savannah, Georgia, is that different? Is that so it's just. But, it's interesting how insurance companies look at risk, right? They look at it. You're in this state, you're in this area, you're a part of this. We are able to find insurance. We're able to make it work. Obviously, if it costs more, it costs more. And that just usually goes down to higher rents, right? So that's another factor that as interest rate costs are going up, or other expenses might be going for labor and other things, just another cost that causes rents to rise even more. So eventually all this stuff, especially when you're an owner of a multifamily building, the value is based on the rent. So if you can just, for whatever reason, rents go up, it helps you as an owner because you have leverage, you have 20-30% down. And if the property goes up in value, you dramatically benefit from that. So it doesn't necessarily hurt us, but it may be in the short term, just of the, next few months, but over time, the rents just generally rise because of increasing costs such as that.
Yeah, man, it'd be interesting to sit down with an actuary that knows that market and see how they're calculating things and get their take on it. Jen, I kind of cut you off earlier.
Oh, you're muted there, Jen.
It's my delayed out in the country, stuff. I'm thinking about, again, I tend to think, 4 or 5 steps down the road is what's going to happen later. One of the things to understand about the data that is in this article is it's history, right? It really it's not including anything that's happened from the recent hurricanes that came through and how devastating that is. And people are still, without electricity, without food, without water. I mean, all that, it's just a nightmare down there. So we still don't know what the impact of that's going to be. To speak to your thought about reinsurance, if we think about the single family market and we think about private mortgage insurance, that I think would be one of the best solutions for this, to understand that. So if you put 20% down, you don't have to have private mortgage insurance. because the lender feels that they have enough equity in the property to pay for fees and legal fees and repairing the house, et cetera, if you were to default on the loan. And so anytime you put less than 20% down, the lender wants a partner in there to help pay for the difference when, the house goes into foreclosure. I think that would be a splendid idea down there, to have sort of this private, securitized private mortgage or private insurance on the reinsurance of properties down there. The challenge becomes, in the case of a single family home, you put 20% down, you put 5% down. We already know that that's what triggers it. It's what is the trigger. And it can't be as broad as, well, if you live in Florida, that's the trigger. It has to be, by area. And I would think that if they could come up with something that was similar to the 100-year flood zones and things like that, someone could pay a little extra to have that reinsurance available to them. And I think it would be much more beneficial than a blanket policy that, we're just going to, I'm going to present this, $1 billion deal or bill and everybody gets to pay for it. I don't think that that's a fair assessment on it. And I also feel, and I know our investor friends may not like this, but if you're going to be an investor down there, you'd pay a higher premium because it's investor, to be able to have property and make money in that state. So I don't, the question is it a Band-Aid? I think it's a Band-Aid for now. And then there's going to be more problems coming down the hill, down the line, and they're going to have to come up with something really solid in the future.
Yeah, I want to just add to that too. I do have a friend who sells insurance in the airline or the basic airplane insurance, and he was talking about this issue with Russia. Russia recently said, "Oh, all the commercial planes that are here, we're just going to keep them. We're not going to give them back." Right? And these are like $100 million a piece airplanes, right? So we're talking, it was like $4 billion worth of airplanes or something like that. And my friend was just saying, if we don't get those planes back, and this was months ago, which it looks like we're not going to get those planes back, but the airline insurance premiums are going to double or triple just from those costs, because at the end of the day, it's really like a cause and effect kind of thing, right? You can't be paying out billions of dollars for a claim like airplanes or hurricanes and not expect rates to go up. Now, eventually over time, what happens, and I think I've heard Warren Buffett talk about this too, is that premiums tend to be like let's say there hasn't been a significant hurricane in 5 or 10 years. Well, then premiums are actually really low, right? They're actually way low, below what they should be. And then when there's some big event, then it raises things to go up. It's like if you get a ticket with your, on your car insurance, right? It raises your insurance dramatically for the time because it's, now you're a risk, or now this has had to be paid out or whatever. So I think, I don't know if there's really a simple solution to it. I just think that you have to calculate that in your numbers as an investor. You've got to be very conservative, and you've got to realize that, hopefully Florida will get it sorted out. I personally am a big fan of Florida because I think a lot of people love to live there. They love no state income tax. They love the weather. A lot of people love the politics. Some people don't, but a lot of people love them. And especially a lot of that demographic that's getting to be an older, the boomers that are retiring, they want to move and they can live, the average house, 3-bedroom house in Pasadena, California is 1.2 million. Even still, and in Jacksonville, it's about 300,000. So you get about 4 times the house for the same money. And so there's reasons why people want to live there.
Yeah. Well, while we're talking about Florida, let's jump into the next news. Cision PR Newswire via Yahoo Finance. Titles: Miami real estate records 4th best sales year ever. 11 consecutive years of price appreciation. Miami's market is booming due to many factors, despite what is going on around the country in other markets. South Florida real estate is different because their housing demand continues to be fueled by in-migration, both domestic and international. This influx of people and companies moving into the region, coupled with the ratio of cash buyers, which is nearly double the national average, should continue to shield Miami from the impact of high mortgage rates. While overall inventory is on the rise, most of the growth in listings is at the top end or luxury segment of the market. Miami single-family inventory in the $400,000 to $600,000 price range, for example, is at 2.7 months of supply, well below a balanced market of 6 months. The Unemployment rate is 2.3% compared to 3.7% nationally. Distressed sales are statistically insignificant, reflecting a healthy market. A high percentage of the workforce working remotely favors the Miami market, where many have relocated to live, work, and play because of the lifestyle, weather, and more. Also, one of the supports for home prices is rents, and rents are rising strongly. So as investors, Bronson, obviously you know Florida. How about the Miami market? And what do you think about opportunities to buy, hold as rentals, or sell?
Yeah, I think we don't buy in Miami or Orlando or Tampa or some of the bigger markets. And the reason why is, I see these markets being more cyclical markets. So California and the West Coast are more cyclical just in general in real estate. So these tend to have big peaks, then they have crashes and things like that. Jacksonville is a little different. It's more of a steady appreciation market. It will have some, it will be affected by other things happening in other markets. But like you mentioned in this article, there's a lot of cash buyers. This is very similar to Los Angeles, actually. A lot of cash buyers, a lot of people coming in probably from other countries, other places, wanting to park money in the U.S. I don't know. I see articles like this sometimes, and I wonder if it's kind of like the sign of kind of like what Jen was saying earlier about another articles, like, they post this, and then does this mean it's kind of over? Like you see this article and all of a sudden things just kind of shift. And then 6 months later, it's like, oh, wow, we just had the best year and now things have turned. So you have to look at the underlying fundamentals. It could be that people internationally, and this is really an issue when it comes to the dollar's been super strong. People are very afraid in other currencies around the world. A lot of currencies have gotten destroyed. The dollar appreciated something like up to about 20% this last year. So just by holding dollars, it just dramatically appreciated, and versus other currencies. So people are looking at that internationally and saying, where do I put my cash? Well, I'll go buy a place in Miami, or I'll go buy a place somewhere. I know we'll go there sometime. So I think there's different factors, kind of leading into that. But I don't know. This is, Miami's not all of Florida. It's probably, it's a very desirable area, but I would see it being very cyclical. And if we have and it may not. We may not see this article in a year or two, but that's kind of my thoughts. What do you think on that, Jen? Love to know your thoughts too. Or James.
Yeah, I don't know a whole lot about it. We did help an investor. Actually, I've got a friend. I helped him get into an apartment syndication in Florida that actually it was crazy. The building got wiped out by, Hurricane Michael, I believe. But they were good operators, got in, fixed everything up, and were able to raise rents because they were the first back online, and it turned out good. So got a little experience going along that journey with my friend. We did a lease option too down there.
I think.
Go ahead.
I think there's pockets that do that. We know in Dallas there's a huge run on, right, that's happening. We think that most of that's coming from people illegals coming over and things like that. But it's growing. And I think that these pockets, I think it's cyclical. I agree with you. I think it's cyclical. I just worry about the whole Miami area, because if you've ever been there, where can they put more people? It's just crazy. I'm wondering where they can put more people. And, I just pulled this up where we're looking, the 2019 crime rate. And if this article is more recent, right, from that, then that means we have more people. The crime rate is up. It's 1.3 times higher than the national average. It's 87.7% higher than at other U.S. cities, right? I'm not saying it's worse, but I just wonder what's going on. We have a lot of transient. We have a lot of, illegal. We have a lot of foreign money coming in. We have domestic, like you said, and it said in the article, we have a lot of people, fleeing there. Tons of people in California that I know are fleeing down to Florida. People from the Northeast are fleeing down to Florida. I just wonder how long Florida can operate in the manner that it is, being a income tax free state. And I think that there's going to have to be some changes to just kind of halt people from coming in. They have to have some consequences, and they might be unintended consequences as well. I mean, it might hurt them in the long run, but that's the first thing I thought of is if there's an influx of people going down into Miami, to this magnitude, what's going on with crime? What's happening there? And, I'm not sure I'd want to go down there to be an investor, to have the liability. I wouldn't want to go down there to be, and not to say, I mean, I have an investment, a syndication investment with Grant Cardone down there, one of his multifamilies, but I'm not sure that I personally would want to be investing right in there right now just to chase appreciation. You just got to weigh it, right? You got to weigh it. I don't really know how to think about this thing. I'm like, okay, let me think about that, right? Let me think about what's going on down there. What does that really mean? Yeah.
Well, let's go to the next article. This was an interesting one from the White Coat Investor. I hadn't heard of him. He's a doctor, but a very serious investor in all sorts of things. So the title's The Biggest Investment Winners and Losers from 2022. I'll summarize the different types of investments in the article and then share some of the stats on just the real estate investment side because it went pretty deep. So according to him, and he's got stats to back all this up, losers include stocks, publicly traded REITs versus privately held REITs, the effect of the Federal Reserve being too aggressive for too long with inflationary measures, nominal bonds, tips, which I had to look up, cryptocurrencies, NFTs, and precious metals like gold and silver. Publicly traded REITs, for those that don't know what that is, it's real estate investment trusts. Got hit hard with Vanguard's REIT index fund down 28%. Then winners include iBonds, TSPG fund, private equity real estate, private debt real estate, value tilting, the US dollar, the strength of it, Social Security, and energy stocks. Private equity REITs, getting into the real estate side, are up around 17% compared to publicly traded REITs that were negative 28. And private debt, while being the least tax efficient, is up 7 to 8.5%. And a lot of these stats are just on his portfolio, so he's kind of an open book and sharing what he's experiencing with the things he's invested in. But they're probably a pretty good indication of what's going on overall. So there'd be a lot to unpack if we were to dive into all the types of investments in there. And, I'm not super familiar with all the differences between publicly traded or private equity REITs. So if you guys have anything to add to that.
Yeah, I'm familiar with this guy, the White Coat Investor. I worked for 10 years in medical device sales. I'd worked with a lot of physicians, and it's interesting. I read the article. He's got a lot of information. It's a little kind of very nerdy, and he gets into a lot of details, which is good. But I can tell he's very much got a bias for paper assets. He's doing a lot of REITs and tips and all kinds of things. And it's interesting about physicians, and I hope I don't offend any physicians that are watching this now, but sometimes what makes people great physicians also can kind of make them not great investors, and or not great with their money. And the reason for that is that with practicing medicine, and this guy he's a physician. I don't know if he still practices, but basically it's all about facts and data and studies and information, whatever. But the challenge is when you go into investment, you don't know. There's no way to really prove it a lot of times. Or you can kind of say, well, here's the team and here's this, whatever. And there's kind of a sense that you get about it, but you can't look at it and just say, and I think sometimes when we have all this data, and even the thing of like the best and the worst of 2022, that's helpful looking back, but there's all those disclaimers, right? Prior performance does not indicate how this will do in the future, right? And so on one hand, like you can't, like just because it was good last year, it might mean actually it may not be as good next year, right? So I kind of look at, it is good to kind of analyze your own investments and see what did well. But again, is that really helpful? I guess in a reflective sort of way, maybe. Yeah, you can look back and say, oh, this worked, this didn't work, or I missed this trend or whatever. But I think it's more important to look forward and say, well, what do I see really working better in the future? So I mean, I think that it is an interesting article. He's got all kinds of information, and if you invest in TIPS, which is Treasury inflation protected, bonds. They haven't done well. They were supposed to hedge against inflation, and they haven't. And a lot of these other assets that promised to do well have not done well. And it's interesting that he has both kind of like ETFs and like kind of for precious metals, and then he actually has precious metals, like physical metals, listed as like a separate thing in there, which I do some precious metals just to hedge against inflation and keep purchasing power rather than holding cash. But people look and say, well, it's not a good investment. So I don't know. I mean, I think there's a lot in there to unpack. I think the approach, though, is a very kind of Wall Street centric approach. And he does talk about private equity. I think he talks a little bit about private equity real estate deals, which is what syndication is, which I think is good. But I just felt like it was just like so much there. And the takeaways were, okay, how can I really apply this? I was a little challenged on how to apply it.
Yeah. With private equity, is he also maybe talking about hard money loans to flippers? It's kind of assuming that that's lumped in there too.
He says real estate debt. So he's talking, he's just talking about, well, actually there are funds that do this too. So private debt. So it could be like, hey, I'm giving these guys, it could be flipping, it could be long-term hold, it could be whatever. And it's usually 7 to 15% or higher. You can say it's backed by the asset. So if something doesn't go well, then you're like first in line to be able to get the asset. So
Jen, what do you think?
Yeah, I mean, I agree with everything you've said. I think this article was very confusing for the reader. If you're not financially, you haven't been in the financial services industry, you haven't played in any of these markets, and you've been a doctor the whole time, right? I think this is really, really malpractice. That's what I think it is. Right? It's a type of malpractice. I think there's too much information being given, and it's confusing. And even for us, that we understand most of this terminology, but there's some things in here I didn't understand either, and had to look up and still haven't sorted through them. I think it's very risky. If you're going to be a white coat investor, just make it simple, make it easy, to help people understand. The thing that he's done is he's covered himself by saying there are these things that you could do that will perform this year, but might not next year. And here are some other things that have performed this year, or that haven't performed this year, but they might next year. So somehow, some way, if you just dabble in all of this, you'll be fine. And I think that's just malpractice in this environment. Yeah.
Yeah. There's a thought too of just like, being your own portfolio manager, which I think there is. I honestly think that if people do some research and study it out, I think it is, having a money person that charges 1.5% to 2% per year on everything. You can make some mistakes, and asset allocation. I mean, that's the whole, how much goes to this asset, and he's got a whole kind of formula here of this percentage to this asset and this to this, and it is a bit complex. And this guy, to try to share all that, I think it gives doctors lots of data. Because again, who is this really written to? It's written to doctors, but how do you apply that? What are you going to do with that? I think what it does is it makes the guy look really smart, and then he sells a $2,100 course on his website on how to invest. So he's going to teach you how to analyze all this stuff. But anyway, that's one strategy though, is just to give people stuff that's like a lot of information they can't understand, and then you like gonna kind of break it down for them, right? So I'm not saying that's what he's doing, but it can feel a little bit that way. And if he's watching, I don't mean to offend you there.
Sorry. Okay. Yeah, sorry.
All right. Let's jump into our fun news item. CNBC says kidults are the biggest sales driver for the toy industry. There are two things keeping the toy industry afloat right now: inflation and a consumer group known as kidults. Basically anyone over the age of 12. These kids at heart are responsible for 1/4 of all toy sales annually, around $9 billion worth, and are the biggest driver of growth throughout the industry. Kidults, who tend to spend more on toys, have a great fondness for cartoons, superheroes, and collectibles that remind them of their childhood. They buy merchandise such as action figures, Lego sets, and dolls that might typically be considered for kids. However, in recent years, toy makers have created product lines just for these consumers, realizing that demand is high for this generation of adults who still want to have fun. Toy companies have even begun creating their own television and movie content in order to support toy lines. Mattel launched its own internal movie company and is set to release Barbie in July 2023, and Hasbro will release Dungeons and Dragons Honor Among Thieves in theaters in March. So can either of you guys relate to that or know anybody that fits that kidult category?
How honest we want to be on this, right?
Come on.
Yeah.
It's just us here. It's just us.
Just us,
Yeah.
right?
No one's
Yeah. I
listening
mean, I just think, I don't get into any of that, right? Like, I don't have time for that. I'm too busy doing, all kinds of things and investing. But it's funny. It's like, they want the toy, but they can't play with the toy because if you take it out of the box, it's not going to be worth the money. And if we're talking about investing, right? I mean, this is what this all is investing. We know Jordan's work, and we know, whatever his name is, Star Wars, right? All that stuff works. So, I just think it's another type of investing. It's a fun way for people to do it who are, really excited about those types of things. I mean, every place you look, there's a new superhero somewhere, and I can't keep up with my grandkids, which superhero they like this week. So I think, it's a fun way for people that maybe, aren't ready to go into real estate investing or other type of investments to feel like they have an opportunity to partake in, in something that will increase in value over time, and they get to enjoy it in the process. I mean, I think that's just really what it is,
Yeah, I think it's interesting. There was a year, I think it was like 10 years ago or 15 years ago, where the sales of video games eclipsed the sales of movies for the first time. So they'd be like, the ticket sales going to the movies was actually eclipsed by the amount of video games that were sold. And so, my generation, I'm 42, a lot of us, we raised on Nintendo and video games, other things, and then just having more opportunities to buy toys and buy stuff. And I have friends that, they have, they buy Lego sets and they do all kinds of stuff. I don't know, necessarily buy toys. Mine are more, I love going on trips and, I don't know, experiences, but for, I have friends that get into all that stuff. They have their hobbies and they have collectible items they enjoy. And I think, like I talked about, this is one of the fastest growing segments. And I think particularly for millennials, I think it's a huge thing. A lot of millennials might be, I don't know, the age group, maybe 20s and 30s. Like there's people, they want to continue to stay connected to that. And even it was, the article talked about, shows and movies, like there was like a Dungeons and Dragons movie coming out and some other movie that's like, these are like basically kids style movies, but they're not marketed to kids, right? They're adult movies that are like cartoon, or there's some sort of like, this is a kid theme, but it was like when we were kids. And so it's interesting now that all these entertainment things are coming out of things when we were kids, but it's the same stuff that happened like from the 60s. Like my parents were like, oh, the different bands that are coming back to play again now, or the different things. So there's different ways that people are doing it. But yeah, I think one way is obviously now is toys, which is interesting. Yeah.
I can kind of relate to this, not with toys and action figures and stuff, but I got into snowboarding in the very beginning, and that goes back, 30, 40 years or something almost. And so there's nostalgia there for me. And so I started collecting some of the boards that I had and knew, from way back. And guess where they are? They're in self-storage right now.
I love that. I love that Antonio put that in there. He said more things for storage. Yeah.
Yeah.
That's awesome.
I love it.
Cool.
I love it.
A little special news item here. Tune in tonight at 5 p.m. Pacific. Join Antonio Holman, our producer, and 8 special guests for the At Year's End Recap Summit 2022, where they will help you close out the year with a recap of important 2022 industry events, 2023 plans, and gratitude. Catch the show live and join the live chat on UnitedStatesRealEstateInvestor.com. Again, that's UnitedStatesRealEstateInvestor.com. Facebook, LinkedIn, YouTube, and Twitter. Again, that's at Year's End Recap Summit 2022 tonight at 5 p.m. Pacific. I'd like to thank our sponsors, Jason Palliser's 2-day investment blueprint and REI Content Packs, and our guests, Bronson Hill, Chris Prefontaine, and Jen Duplessis. Also, thanks to our producer, Antonio Holman with United States Real Estate Investor. Follow and subscribe to This Month in Real Estate Investing on your favorite podcast app. And remember, when one door closes, another door opens to financial freedom. Thanks, everybody. It's great to have you on.
Nice to meet you, Bronson.
Guys. Thanks.
See you
Nice
next
to meet you.
month.
Good to see you,
guys.
James.
See you.
Everybody, Happy New Year.